Hey guys, Max here, and this is your daily market update for yesterday, the 5th of January. What happened? Well, stocks crashed, or at least they continue to crash. Either way, they fell. China's stocks crashed, America's stocks crashed, pretty much everything fell. The world index fell as well. China is shutting itself off from the world on fears from the Omicron variant, and of course, there is still chaos in Turkey, as is usual. So what exactly happened in the markets? Well, the day before yesterday, US markets as a whole were fine, but tech and the Nasdaq took a major drop. Now, yesterday we then saw tech drop even further, but this time it was enough to impact the whole S&P 500. The index fell about 2% and the Nasdaq actually fell 3.1% in just one day. We also saw a pretty major drop in the real estate sector, but really no area in the US was particularly safe during the day of red. Tech obviously had the worst time of it, as was fully expected. Yesterday we spoke about Cathie Wood's ARK-K Innovation Fund, the ETF that is supposed to pick out the super winners of the future, the next Amazons, the next Teslas and Googles, and it's sort of become a proxy for the hyped up tech market as a whole. Now you probably won't be surprised to hear then that ARK-K had an absolutely awful day, falling over 7% in just one day. Now that's on top of their losses the days before, which means compared to the beginning of the week, ARK-K is down 13%. Over the last year, the fund is down 33%, and from its all-time high, it's down 45%. Now, needless to say, Cathie Wood and her tech dream picks are not doing well at all, and they haven't for some time now. What kind of companies are actually in this portfolio? Well, it's the exact ones you might expect to see. Spotify, Coinbase, Zoom, Roku, DocuSign, Robinhood, Twitter, Palantir, and the like. Of course, there's also a huge amount of Tesla in the portfolio, but if you want to see a basket of stocks that have been overvalued after the pandemic and have been on a downwards trajectory as reality comes back to the forefront of our markets, then having a look at ARK-K is going to be perfect for you. We also saw a meme stock AMC fall as well, down 11%, and it's now at its lowest point since January last year, just before it started to pump. Of course, it's quite a speculative bet, so it's plausible that it will just move in line with investor risk sentiment, something we see happening with the crypto markets as well. Now, unfortunately for the rest of the world, this US-based tech rout seems to have spread overseas and is now hitting some tech abroad, particularly in Hong Kong and China. One gauge of Chinese tech companies listed in Hong Kong has found itself at a 6-year low, which I'm sure I don't need to tell you how awful that is. I do wonder if there are still people out there in the comments telling me that I'm wrong about China's markets, but we'll just have to wait and see for that, won't we? European stocks surprisingly held up pretty well on the day. The Stoxx 600 and the FTSE 100 actually rose a couple basis points each, bucking the trend seen elsewhere. Really though, this isn't too surprising. These markets, these indexes have always had very light tech weightings, as practically the entire tech ecosystem across the entire world is either in the US or in China. Now, crypto actually had a bad day as well, with the market as a whole seeing a pretty large decline. Bitcoin was obviously sitting at about $46,000 over the last couple of days, and the weeks prior it had been hovering around $48,000. But yesterday it saw a pretty crazy drop and is now sitting at about $42,000 at the time of making this video. Of course, the crypto market and Bitcoin has moved in unison altogether. Pretty much everything is down 5 to 10%. Ethereum, Cardano, Ripple, Binance Token, and then a few more have actually been falling a fair bit more, and they're sitting at above 10% losses for the day. Once again though, this is just more evidence to the fact that Bitcoin and crypto as a whole is a speculative risk-on asset. It is not a hedge against inflation. What are bond yields doing right now? Well, they're rising, and yet crypto is falling with the market, not moving in the opposite direction. I really do think we're at the point now where no one can seriously claim that Bitcoin is an inflation hedge. You might try to use it as one, but it just doesn't behave like that right now. It moves with the rest of the markets. It's just like buying a triple leveraged ETF of the tech sector. And I know that's going to upset some people, but that's just what it is. So, final bits of the market recap. What's happening? Well, bond yields are rising, finally, reacting to inflation and interest rate rises that are due to come soon now. Crude oil and gold hasn't really changed all that much. The MSCI World Index is of course very heavily US and China weighted, so it has fallen about 1.4% with those markets yesterday. But to be honest, the rest of the world has actually done okay. So if that's what happened, well, why did it happen? Well, it's very simple, to be honest. Last month in December, obviously the Fed came out and they announced that they had decided to double the pace of their taper and that they were going to raise interest rates 3 times throughout 2022 until interest rates sat at about 0.9%, and then they'll continue to raise them in following years as well. Now, what did this mean? Well, it meant that asset inflation by Fed purchases would slow down over the next couple months and eventually stop altogether. Prior to this, the Fed had been buying fixed income assets at a rate of about $120 billion a month, and they'd been doing that since the start of COVID, so for almost 2 years, and that's been inflating asset prices by pumping the market with liquidity. That's one of the reasons the stock market has risen by 50% since the start of the pandemic. The Fed's accelerating taper basically means they're going to wind down these asset purchases faster, and in the long run, it means less asset purchases altogether, so less asset inflation. This probably won't be a surprise, but this is bad for asset prices, stock prices, bond prices, housing prices. Name an asset and the chances are it's been inflated in value by the Fed's purchases and their injections of liquidity over the last year, and that's going to change. Then we have the interest rate hikes as well, and here it's a similar story. Super low interest rates, which we've had for a couple years now, practically zero even. And they inflate prices because they incentivize people to take out debt and invest with that debt, whether that be through getting a larger mortgage on your house or taking out loads of margin with your brokerage. The end result is the same, it's asset price inflation. Now, interest rates also allow companies that actually need a lot of capital to grow access to that capital for cheap, and this helps fuel their growth. Think of the cost needed to grow the next Google. They need to hire loads of staff, buy some awesome computers, a huge office space, advertising and everything like that, and that all requires capital. Raising interest rates makes that capital more expensive, which makes it more expensive to grow, and that just reduces the rate of growth for companies that are like this. In short, high interest rates stops people from taking out as much debt, which helps to fight inflation. So that is what the Fed said they were going to do, but the market never believed them. If you go back and watch my videos as this news came out, you'll hear exactly that. On the day the news broke, stocks panicked and they dropped a little bit, but within a couple of days, the markets had convinced themselves that the Fed was all bark and no bite. They were just claiming that interest rate rises would come through, but they would never actually have the balls to go that far. The markets thought that the Fed was just claiming that asset prices would completely end, but when the time comes, the market thought that they would reverse their decisions and continue pumping everyone's portfolio. The real problem here, and the cause for this flash crash, is that we just got minutes from the FOMC, the Federal Open Market Committee. Basically, we know what was said in that meeting, and the market was wrong. The Fed is taking inflation seriously, and they are going to go through with these plans and likely even make the plans stronger in the future. They were talking about raising interest rates even quicker and even faster than they had originally planned, and for longer as well. And they were talking about reducing the Fed's balance sheet, actually selling the assets that they've been accumulating over the last couple of years. And this would be huge for asset prices, huge in a bad way. It would really cause a big market rout. It would do the complete opposite of what quantitative easing is. Now, before the other day, US markets were once again at all-time highs because investors got cocky and they thought they knew exactly what was going to happen, so they continued to buy with this extremely cheap capital that's just floating all around, but all of that has been turned on its head. These investors, these institutions that had bet on an overly dovish Fed were wrong. The Fed is not on their side anymore. The Fed wants to fight inflation, and that means asset prices will fall. Investors want to squeeze every single penny out from this bull market, and so they will stay invested for as long as physically possible, but they will eventually pull their money out. What we saw yesterday was a lot of people pulling their money out. A lot of people deciding that this news was too scary, that this could be the top, that this is their final hurrah, and that it's time for them to take profits and reduce their risk. Now, is this actually the top? Maybe, but seriously, no one knows until it's already gone. And it's pointless actually trying to time the absolute peak of the market. The important thing here is that you don't actually need to time the top of the market perfectly. You just have to get out before the actual crash happens. Everyone has seen crazy growth and crazy gains over the last couple of years. We're all very far in the green. Taking profits now is not going to make you go broke. Now, whether or not you get out now or wait another 2 months and make maybe an extra 3 or 4% on your positions, in my opinion, really won't make a difference in the long run. But not actually getting stung by the market turn, not getting caught holding the bags when the crash or the correction finally comes, now that will make a big difference in the long run. The tide is changing, the Fed is pulling the lever that is changing that tide, and this is actually a good thing. Portfolios will be red over the next couple of years, but that will set the stage for a healthier economy and another boom cycle in the future. This artificial market based on 0% interest rates and the Fed's money printing is not sustainable, but more importantly, it isn't even valuable. All this wealth that the Fed has created is just numbers on a screen in a tower in New York. It isn't making the people that the Fed is meant to serve wealthier. It isn't improving their quality of life, and it's a good thing that it's on its way out, even if it means a short period of pain. As long as the Fed stays true to this course, we should see inflation start to come down as well, which is one of the most painful economic events that a family, an average person, can see in their lifetime. Reading these minutes, I've actually been very pleasantly surprised. What I see is a Fed that is finally starting to take their responsibilities seriously, to slow down, to take a look at the bigger picture and realize that keeping interest rates low and QE high isn't going to help anyone in the long run, and they need to change their ways. Now that's the big news for the day, obviously, but of course it's not everything. So we move back on over to China, where lockdowns are coming back into force, and it's a little bit worrying for the Chinese economy. We mentioned this a few days ago, but the Sinovac, the vaccine developed by the Chinese state, had never been very good. It had always had pretty low efficacy, especially when compared to Western counterparts, and in particular, even being triple jabbed with it doesn't protect you against the Omicron variant. Of course, almost every vaccine dose given in China has been the Sinovac one, so the country is likely not going to do well against Omicron at all, and we're already seeing that start. Now, for full transparency, China claims that Omicron isn't in the country. They claim that this is the Delta wave that they're fighting, but anyone with even the slightest amount of skepticism in them knows that that just isn't the case. They fully locked down a city of 13 million people a week or so ago, and it looks like there are more lockdowns like that coming. They've started introducing restrictions regarding dining in restaurants and things like that. The country is also starting to ban travel from foreign countries in an attempt to stop the virus getting into the country. But if we've learned anything over the last 18 months, it's that travel bans don't work, especially when the virus is already present in your country, and especially if you're not a tiny island who doesn't need to let people into the country to function. China has over 1 billion people, and it's a mainland, and it has borders. There's no way in hell they're going to stop the virus from spreading into their country. Now, Hong Kong has banned flights from a bunch of places like the US, Canada, the UK, and a whole lot of other places as well, and we're probably going to see more news like this coming out over the coming days and weeks. Now, there is some concern regarding China's demand for commodities and oil as a result of these developments, and to be fair, this isn't entirely unfounded. When people are locked down, businesses shut, vehicles stop driving, factories stop operating. Energy demand falls and commodity demand falls as well, so this is a legitimate fear that really isn't anything too far-fetched. Let's not forget that the pandemic once caused oil prices to go far into the negative because demand for said oil was just so low. And while I don't necessarily think that we're going back in that direction today, the idea that oil demand will fall because China is going into a lockdown is very reasonable. And that of course leads us on to Turkey, another country in a lot of trouble, but for distinctly different reasons. So what's new? Well, the Turkish central bank has bought government bonds for the first time since the initial COVID scare in an attempt to drive down borrowing costs as they are surging despite Erdogan's aims. The bank bought about $20 million, US dollars that is, of bonds as the yield on 10-year bonds had risen to about 25%, but after they made this purchase, it fell to just below 24%. Now you might say, okay, their aim was to reduce the yield. It worked then, right? It dropped the yield by just over 1%. So yes, it did work here, but the underlying causes of the problem are still there. So give it a week or a month and we'll find Turkey in the exact same problem again, as borrowing costs just continue to rise again, and they'll have to take more action. Now, every time this action is taken, its effectiveness will decrease and eventually it will fail to work at all. Now, make no mistake, this is a short-term fix, and the word fix is still rather generous as nothing is really fixed, it's just kind of hidden. Of course, now there is also more trouble across the country as the lira has not been performing well at all. Erdogan has put forward some new rules to try and keep demand for the currency high. They're demanding companies hold a certain amount of their cash reserves in lira, and in their most recent move, every lender is required to report their dollar purchases to the government. Now, this is not an official policy, they haven't announced this, but we have heard leaks from institutions in Turkey telling us that this is the case. The government is basically keeping tabs on investors, on businesses and banks and the like. What will be done with this information? Well, right now, not much, but in a couple of weeks or months, I wouldn't be surprised at all if this information was used to choose which institutions to target, which ones haven't been loyal enough, and also which ones have enough money to make going after them worthwhile. Asset seizures in Erdogan's Turkey have been seen already, and I guarantee they will be seen again. Finally, I thought it might be interesting to look across the other pond, across the Pacific Ocean this time, and over to Japan and the yen, as JP Morgan has put out some data suggesting that the yen is at its weakest point in history. The currency has been declining in value since the onset of the virus, and it's been particularly bad during the end of 2021. Now, why is this? Well, consensus at the moment seems to be that Japan's monetary policy is so ridiculously dovish that the currency behind that policy is just destined to be weak. Of course, we've had lots of money printing all over the world throughout the lockdowns, but in Japan, they had loads of money printing before the pandemic as well, and now that the pandemic is mostly over and other developed economies are returning to normal, ending quantitative easing and raising rates, Japan is not doing the same. They're not normalizing their monetary policy. Now, in their defense, their economy is just so damn stagnant that even these days, they aren't seeing much inflation at all. I think it's sitting below 1% right now, and there just doesn't seem to be a way out for them. The country has been stagnant for decades, and nothing they seem to do is helping. I certainly don't have any clue about how any of this is going to get better for them, whether or not they normalize their monetary policy. Now, that is it for the day. I'll see you all again tomorrow. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like the USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.